Well, good morning, everyone. Thanks for taking the time out to be here to hear about the case for silver. And that will be followed by 5 exceptional junior companies, silver juniors, that I think you'll be quite impressed by. So let's get started. You may be wondering what's happening with silver, why, if you follow the space, why silver has pulled back in the last month or so, and you don't have to look very far. Silver competes like any other investment asset with other assets, and it's priced in the dollar. And the dollar has been basically producing a counter trend, what I consider a counter trend rally. And so silver has been pulling back on that basis. I think the dollar has a little bit higher to go still. We will see. But silver right now at least is at its 200-day moving average, which I think is going to provide some strong support. The dollar may run to its own 200-day moving average around 106, providing some overhead resistance. Either way, I think that this move is running its course, and after that, we should see some more support for the silver price. I'm going to talk a little bit more macro right now. I did mention the dollar, but I think if you look on the longer term, the US dollar has peaked. If you go back about 30 or 40 years, the US dollar index has been gradually making lower highs. In 1985, it peaked at 160. In 2002 at 120. Last year in September or so, it peaked at 112, and we're currently at 104. My target is for the dollar to continue to fall medium and long term. My first target is about 95 and ultimately at least 90, which is where it bottomed in the last 5 years or so. Would not surprise me to see it fall farther even from there. Looking at inflation, which is obviously something that's on everyone's minds. Well, what happened in the last few years is that when COVID hit, people stayed home and bought physical goods, especially. Obviously, they ate at home, but they also bought things like computers, laptops, tablets, all kinds of goods to entertain at home. They started renovating their homes rather than traveling, and so that caused the prices for goods to surge. And then we had issues with supply chains with the Russia-Ukraine war that affected energy and so on. But now that we're exiting COVID, people are reverting back to their more typical behavior. So that's inciting demand for services of all kinds, travel, entertainment, food, even insurance, things like car insurance. These things are all starting to kick in. And so the service side of inflation has not seen the reprieve that we've seen on the goods side of inflation. And so with about 70% or more of the US economy and most developed economies having services a very large part that drives the economy, and seeing services not only not pull back but continue to rise like this tells me that we're going to have a hard time trying to get inflation to pull back much lower, as despite what the central banks are doing, and especially what they're saying, I don't see that happening with much ease. What are consumers expecting in terms of inflation? Well, when you look out over the next 12 months, they still see a year from now inflation at 5%, and yet the Fed's telling us that their target is 2%. And if you think about that and you look at how the behavior of consumers has been over the last little while, well, recent numbers in the US on retail sales have been surprising to the upside. And I actually talk about this in my book, where I explain something called inflationary psychology. And that's where you have people initially not really understand or believe that the inflation is going to be sticky and that it's eventually going to go back to where it was prior. And so they have this bias towards things going back towards where they were before. But over time, as they see that these levels of inflation stay higher, they start to accept these higher levels, and then they start to react and behave accordingly. And so I think that what we're seeing in these higher retail sales is people saying to themselves, I had these purchases in mind. I've been putting them off for a while. I now see that inflation is up and staying high. I'm not going to put it off anymore. So I'm going to actually now go out and make these purchases because they realize that if they put it off for a few more months, the prices of these goods are likely to still keep climbing higher. The bond market agrees with consumers. So consumers are expecting 5% a year from now. The one-year U.S. Treasury is also forecasting that rates a year from now are going to be, inflation rates are going to be about 5%. That's just a break even. So now I like to say that 4% inflation is going to be the new 2%. If you look at things like debt levels, commodity scarcity, high employment levels, the war premium, and now the green transition, all of these things are going to help contribute to rising demand for commodities. Silver has applications across the board, and so I think that we're going to be in this new paradigm of a new, ideally at least for the Fed. I think that they're telling us 2%. They'll be very happy for multiple reasons with 4. This current inflation wave may be pulling back, but I don't think by any means over the next decade or so inflation is anywhere near over. I think that the market is making a mistake looking at this wave, seeing the pullback and comparing it to the most recent event like that, which was in the late 70s, early 80s, when you had inflation obviously at much higher levels. So the Fed stepped in there for, again, multiple reasons. They were able to crank rates up very high, cure that, and then we had decades of approximately 2 to maybe 3%. But I think that this wave is more comparable to the first wave in the 70s that was followed by 2 more subsequent higher waves of inflation. And so that's why I think that really we are headed into an entire decade at least of higher sustained inflation. And despite what the central banks are doing, the tightening, I'd say don't be fooled by that. You've got governments, so this is on the fiscal side. There's plenty of spending to make up for this supposed hawkishness. You've got the U.S. This is just in the U.S. The Infrastructure Act. That's $1.2 trillion of new spending, very strong for infrastructure and things like charging networks for EVs. Big demand there for silver. The U.S. Inflation Reduction Act is about $370 billion. A lot of that is going to renewable energy and climate measures. Again, very big implications for silver, especially on the solar side. I talked about at the very beginning about how silver and the dollar are negatively correlated. Well, if you look back over the last 20 years, they're actually minus 80% correlated, which is a very, very strong negative correlation. So if you want to determine what you think your outlook is for silver, obviously there are all sorts of things to consider, but one very strong indicator is what the dollar has done. And that has many times over time in the last 20 years very much predicted where the silver price would go. And investors are really starting to look at alternatives. If you consider just since last September, the dollar is down, US dollar index is down 5%, gold is up 8%, silver is up 16, and the gold and silver miners are up 20%. So really you've got investors are really starting to look at alternative assets. Some research by Oxford Economics looked back over the last 23 years and decided what would the ultimate, the ideal optimal allocation to silver be for to reduce your risk and to increase your returns. So remember, you're adding silver to your portfolio and you're accomplishing 2 things. You're improving your overall outcome in terms of returns, but at the same time lowering risk. So it really is kind of the best of both worlds. So it turns out that the ideal allocation to a medium risk portfolio would have been about 5%. Then Oxford decided they would look forward over the next 10 years with their projections. One of the inputs to that is the silver-gold relative ratio, and they see silver as much underpriced versus gold. And so they determined that a slightly higher allocation to silver over the next 10 years would make sense. In fact, they also tell us that the average portfolio right now is only about 0.2% exposed to silver, and that's through that's indirect exposure. Often it's through commodities funds and so on. So if you do the math, you realize that to get to 6% for the average portfolio would take 30 times the current exposure. So the average investor would need to multiply their silver exposure by 30 times to get to 6%. Even if they were to try to get to 2%, they would still need to multiply their current holdings by about 10%, their silver holdings. And again, investors looking at alternatives. We're in this crypto winter. A lot of younger investors have gotten comfortable with crypto, at least up until recently. And so because of their comfort levels with that, they've looked at alternatives within the crypto space. And so it's interesting that the two largest gold-backed cryptocurrencies, Paxos Gold and Tether Gold, their market caps add up to a not insignificant level of $1 billion. So that tells me that really you've got people, again, comfortable with this space, looking out for alternatives within that space. They've seen how precious metals have performed, and they've decided that they're going to shift some of their capital into crypto-backed currencies backed by gold. We look back, the best analogy for if you believe that we're in a precious metals bull market is the 1970s. Well, stocks struggled. Of course, the S&P and the Dow were flat in that decade, and yet gold was up 1,400% and silver was up 3,700%. So if we're in a new paradigm where inflation is high and remains high, and that we're in a renewed commodities bull, odds are we can have these kinds of returns or perhaps even better this time around. Personally, I think this will actually be outpaced this time. If you look at just the last couple of decades, since 2000, and you ask the average investor what would the best place have been to be invested, and typically the answer is stocks. Well, stocks have done okay, somewhat less volatility perhaps than precious metals. The S&P and Dow were up 200%. Silver was up 370, gold was up 520%. So with albeit more volatility, they've easily outpaced stocks. Silver almost double, gold about 2.5 times what stocks did over the last 23 years. And yes, yet most people don't realize that. And they are still in a very much undervalued territory. If you look at what silver specifically has done since 2000, in the US dollar, it's up 9.9% average annual per year. That really outpaces most asset classes. In the Canadian dollar, it's up 8.5%. And silver in the average dominant currencies, the most important currencies across the world, like the yen, the franc, the Australian dollar, the pound, the euro, and so on, it's actually averaged 9.5% per year since 2000. Again, tremendous returns. And still, silver remains cheap. It's 50% below its all-time high, 90% below its inflation-adjusted all-time high, and when it hit $4 back in, when it hit $12 back in 2020, at the lows of the pandemic panic, that was still 3 times above its 2001 low. So to me, that tells me silver is still well within its secular bull market. And it remains cheap versus gold. And yet silver outperforms gold in precious metals bull markets. It easily did that, as you can see, in 1980, all the way over on the left on a percentage basis. It did that again in 2011. And yet today, all the way over on the right, you've got silver at probably about half the gains overall that gold has in this market so far. So it has a lot of room to catch up. And yet the metal remains hated. It remains, there's lots of apathy towards silver. This chart shows you the SLV ETF. The top line is the price, which reflects the silver price. The bottom line is the outstanding shares. And so in 2020, in March, when March to August, when silver took off, went from 12 to 30, investors participated. The number of outstanding shares of SLV soared along with the silver price, and yet in the last rally that we've had since the fall, you have not had that at all. You've had the outstanding shares actually move sideways while silver went from about $18 to $24. All of this in the face of the highest demand in decades. We reached a new high in demand last year, 1.24 billion ounces of silver. That was up 18%. Industrial demand was up 6%, led by the green transition. Physical investment, silver jewelry, silverware, all of these were up tremendously last year. And this is, in the face of what are now multi-decade record deficits. We had a surplus in 2020, as recent as 2020, of almost 70 million ounces. Last year, the forecast was for 194 million ounce deficit. That was revised recently to 253, so it was a 320 million ounce swing from surplus to deficit in just 2 years. And the Silver Institute thinks we're going to see deficits, persistent deficits, over the next several years. Solar is the single biggest consumer of silver on the industrial side. It represents just 3% right now of global electricity, and the International Energy Agency forecasts that by 2030, the output of solar for electricity is going to be about 8.5 times the current level. So if you assume at current levels, that's about 140 million ounces of silver every year go into solar alone, and you multiply that by 8.5 times, you're at almost the entire current annual supply of silver. So you really have to ask yourself, where is all of this silver going to come from, and what is that going to do to the price? Mine supply peaked about 5 or 6 years ago. Silver is a byproduct of other metals like copper, gold, lead, and zinc. So silver supply is very much inelastic to a rise in the silver price, meaning that helps to feed even higher prices. Mine startups have been declining. So that is very different from what we saw in the last run from about 2001 to 2011. As the silver price rose, we saw a response from mining. We saw more projects come online. That has not been the case over the last 3 years. We've seen mine startups fall despite a rising silver price. The largest producing nations are Mexico, Peru. You've got China in there as well. These two lines, the green and the brown, are Mexico and Peru. And despite this the rising price and the increasing demand, we've seen their output actually fall over the last 5 years very steadily. So silver is a critical metal. If you look at its applications, it's the most reflective, it's the most conductive of metals. Solar panels require, as I say, 12% of demand, and with the green revolution, that is increasing very rapidly. Automobiles, EVs, and even internal combustion engine vehicles use 60 million ounces. That is expected to go up by 50% in just the next 2 years. Electronics currently use about 50 million ounces, also expected to be up about 50% by 2030. I think we're going to see a shift. We're going to see manufacturers really start to take more control of their silver supply. We've seen these kinds of things happen already. Rumors about manufacturers having to or potentially wanting to take over lithium companies. We know that offtakes agree, but I think we're going to see that game stepped up somewhat, and we're going to see companies starting to take control, as I say, either buying into projects or buying companies outright in this space. Gold and silver miners are producing record levels of cash. It's their highest cash levels in their history. And I think this is all going to help create a huge, we've seen a huge gap now form in the M&A space. The best analog is the most recent run-up from about 2009 to 2011. Cash levels had risen dramatically. There was a lag, but M&A really started to kick in for a few years after that. Arguably, a lot of cases they overpaid, but that isn't the point. Right now, we've seen, again, cash levels have soared in the last 3 or 4 years, and yet there's been very little on the M&A side. I think that is really going to start to help things move. I think you're going to see some of the larger producers use their cash and use their shares as currency to help increase reserves and resources, again, take either on juniors or even mid-tiers developers, and that's going to create a lot of activity on the M&A side in this space. Give you just a rough idea, and these are the couple of the largest market cap companies in the silver space. Pan American between 2001 and 2008 was up 16 times. Wheaton Precious Metals from 2008 to 2011 was up 17 times. So I think that all of this is going to feed into the junior space, and we're going to start to see a lot more activity as the market comes to realize how critical silver really is. Talk about all of this in a lot more detail in my book, The Great Silver Bull. And if you want to follow what I do, you can go to Silver Stock Investor, my newsletter, and you can follow me on LinkedIn and on Twitter. Thank you.